Inflation is still a specter over the economy, and it is real. We've got a real-world inflation update. Plus, Washington lawmakers have introduced another bill that would make changes to retirement account rules. That's in today's Fastest 4 Minutes in Finance. Hello once again, I'm Scott Inman. I'm back from vacation this week, and I certainly appreciate John Shrewsbury filling in, but I really appreciate the straw hat he used as a prop. Judging from the Florida beaches, the economy is doing quite well. I did notice short staffs and long waits at restaurants as the labor shortage continues, but I didn't seem to think restaurant or hotel prices were too much higher than normal. Prices, though, are certainly higher in other areas. When I got back home, I had a discussion with a client who is a car salesman, and he told me about the shortage of new car inventories and how used cars were in high demand as a result. Car dealers are literally cutting checks for sellers who are not even looking to trade, and those cash offers are up to 50% above Blue Book values. The cost of used cars and trucks jumped 10% month over month in April and was up 21% compared with a year earlier, making it one of the main drivers of the 4.2% year-over-year surge in the U.S. Bureau of Labor Statistics Consumer Price Index. Core inflation, excluding volatile food and energy prices, hit 3%. Now, John talked a little bit about inflation last week with regards to what we can expect out of the markets for the rest of the year. Investors are waiting to see if recent price hikes are transitory, meaning they won't last long and prices will stabilize. And if so, how long will the transitory period last? My friend the car salesman says his dealership is being told that inventory won't return to normal levels until the first quarter of 2022. But the key takeaway here is they will return to normal. The expectation is that when they do, prices will stabilize as well. And this could happen in most areas of the economy where supply chain disruption is causing demand to push prices higher. We'll see. On the retirement front, a bipartisan bill was introduced this week that would allow workers to make a penalty-free withdrawal of up to $1,000 from their employer-sponsored plan or from their IRA if it is needed for an emergency. The bill stems from the fact that an estimated 4 in 10 Americans could not afford a $400 emergency expense. The bill's co-sponsors said in a prepared statement, quote, "Our common sense bill provides Americans the flexibility to save for retirement now, knowing they have access to some of their money for an emergency and be able to pay that money back into their retirement plan." Well, while this proposal is not necessarily a bad thing, I would argue it is not common sense. Common sense would tell me that you should be more focused on saving $1,000 or even $2,000 in a savings account before you even begin saving for retirement. Your contributions to your retirement account are likely going to be invested in stock mutual funds, which are long-term investments. What if the value of your account is down when you have an emergency? You've got to sell that investment for a loss. Why do that if you can tap a stable cash account for the same expense? As the Apostle Paul wrote, "Everything is permissible for me, but not everything is beneficial." It's best to have an emergency fund in cash so you know it won't be worth less when you need it, and keep your retirement money invested for the long term. Thanks for watching. Want more content like this delivered to your inbox weekly? Visit fastest4.com to learn more.